Hey y'all, John here and welcome back, and today we're going to talk about dividend stocks. These sound like such a great idea, but depending on where you are in your investment and wealth building journey, they could be killing your results. As I say, it's just math, so why don't we dig into it today, talk a little bit about what the heck is a dividend stock, how's it paid, and why can it be a bad idea for many of the periods while you're trying to build up your investments. All right, so if you haven't been here to the channel, please click that subscribe button. I'd really appreciate it. But a dividend stock is really nothing more than a stock that pays you every quarter, typically, a percentage or a fixed fee of that stock. So if you own one share, it might pay $1, that kind of thing. And this sounds really, really powerful because a little imagination, and if you have enough stock, then they'll be paying you. And once that exceeds your income, you're financially free. And technically that's true. Most of my approach and most of what I teach is looking at your investments from a longer term point of view, building up that nest egg and letting it grow as fast as possible so you can eat into it or transition it into something else later on. And most of us, we need that 40 years, that 45 years of working time to build up to it. Now, the more you cut your budget, the more you save, the more you invest, the faster that's all going to happen. But dividend stocks have got one, maybe two, but one really big Achilles heel, and that is the tax rate. So many dividend stocks, not all, but many dividend stocks kind of lag in terms of the percent growth they're going to have. So as an investment, you're not getting as much bang for your buck as you are if you were just purely investing and waiting for the growth. Dividend stocks do throw off that cash, but that is taxed at your current federal income tax rate, plus your state if you have one. All right, so take a look at this right here. Most people are going to fall in that 22% tax bracket. So for singles, that's a little over $40,000, about $86,000. For married individuals filing jointly, $81,000 to about $172,000. Now, initially, when you're investing in a dividend stock, you maybe only have a few shares, and so it's only throwing off a few dollars. So it's not changing your life, but it is being taxed at 22%. As you continue to build, let's say this scenario plays out where you're pouring money into it and you're reaching a point where your income is almost matched by the dividends that are being thrown off every year. There's an excellent chance that at that point you're being thrown into a higher tax bracket. So essentially you're being taxed at maybe 24%, something like that. So the dividends are nice, they're throwing off some cash, but you're being taxed at the highest rate the federal government will allow. There's other vehicles like investment properties and things like that you can invest in where you get tax advantages even as it throws off income for you as well. So a better way in what I teach, what I look at it, is focus on the long-term investment portion of it and build up that nest egg. Because if you keep it for more than a year, it becomes a long-term capital gains. And the peak is a 20% when you sell those stocks, a 20% tax rate. So to me, if you're looking to build the nest egg, don't focus on dividend stocks. They're nice, and it might be something you transition to near the end. As you get to that point where you're ready to step back from your job, or maybe you want some more flexibility, maybe you start moving more money into mutual funds or individual stocks that throw off dividends for the cash that comes from it, so you're not eating into your principal quite as much. That makes the most sense to me. And looking at the tax rates, it's just math. You're going to be hurting yourself year after year after year, paying the maximum amount on that income from the dividends itself. Now, if you're still interested in dividends, the number one thing you need to do is smash that like button for me. I really appreciate it. But there's lots of ways to research it. You can go over to Fidelity, for example, and they offer mutual funds, and you can sort by the dividend that's being thrown off. You can also go to apps like Webull, sign up, deposit your first $100, get 2 free stocks like I have, but it also has this awesome ability to set up sorts, where you can go say, yes, I want North American stocks, I want dividends, I would like the dividends to be in this range, and it'll pull up a list. It'll be searched alphabetically to begin with. I like advanced auto is pretty high. You can sort by dividends, and then you find this one right here, which is Simon Properties. So this is basically they run malls, and they throw off a really good dividend, $1 per share per quarter, and right now it's listed as a buy. So there's plenty of ways if you're interested in it, or if you do want to throw it into the mix. There's a lot of ways you can do this. I just think it's a bad idea because you're going to be taxed at the highest rate possible. So, hey, if you have any questions, if you have any comments, if you disagree with me, if you think I'm absolutely right, leave me a comment below. Really appreciate it, but I hope you have a great day and happy investing.